And now let's look at first in, first out, otherwise known as FIFO. Now, FIFO assumes that inventory items are sold in the order in which they were acquired. So let's just look through some of the transactions here. So we had a beginning balance on August 1st of 10 units that cost us $91. So you can see here our inventory balance is $910. So down here it says on August 3rd, we purchased 15 bikes costing $106 a piece. So we will include 15 more units at $106. So you can see up here we have $1,590 of additional inventory that was purchased. And so our total cost of goods available for sale is $2,500 because we had 10 units at $91 a piece and 15 units at $106 a piece. So on August 14th, we sold 20 bikes. So using the FIFO method, we're assuming that the first units that we received in are going to be the first ones that we sold. So on August 14th, we had 10 units at $91, and that was our beginning balance. So we're going to sell each of those at $91 of cost, and then we're going to have an additional 10 units that came out of this August 3rd purchase. And so our total cost of goods sold from this first sale on August 14th is going to be $1,970, and our remaining inventory is going to be 5 units at $106 because we sold these 10 units at $91 and we sold 10 of these at $106. So those 10 are gone and 10 of those are gone. So we have 5 remaining units at $106. So our cost of goods available for sale is going to be $530. On August 17th, we purchased 20 more bikes for $115 a piece. So that's a grand total cost of $2,300. So over here, we're just going to add that to our total inventory balance, our total cost of goods available for sale. So we have a total of 25 units at a cost of $2,830. And then on August 28th, we purchased 10 more units at $119 a piece. So for a total cost of $1,190. So our total inventory, or total cost of goods available for sale is now $4,020, and we have 5 units that were purchased on August 3rd because that's the remaining of these. We have 20 units from August 17th, and we have 10 units from the 28th. And on August 30th, we sold 23 units. So looking at our inventory here, that 23 is we're gonna sell those first 5 that we got, and we're gonna have a remainder. So 23 minus 5 is 18. So 18 of those units are gonna come out of this second purchase. So our total inventory balance is gonna be the 2 units that were purchased on August 17th because we bought 20 of them and we sold 18. So we have 2 remaining from that purchase, and we have all 10 from the purchase on August 28th. And so there is our inventory balance at the end of August. And our cost of goods sold is going to be the 5 units from August 3rd and 18 units from August 17th that were sold. So that is FIFO, or first in, first out. We are assuming that our inventory that we're selling is in the order that we are receiving it. And if we go to Appendix 5A, if we scroll down here to first in, first out, this is a more condensed version of that. So here's all of our purchases and our cost of goods available for sale. So 10 units of that beginning balance is gone under FIFO. 15 units of the second purchase is gone. And 18 of the 20 units that were purchased on August 17th are gone. We're considering all of those as being sold. So our ending inventory is going to be our 2 units that remain from our August 17th purchase. And all of the 10 units from our August 28th purchase are going to remain in our ending inventory. And so that there is FIFO. It's first in, first out. The inventory that we get in first, we are going to sell first. And again, this is just the cost flow. It doesn't have to match the physical flow of inventory, but this is just the cost flow, how we're going to record the cost of everything. Because as we saw in specific identification, we still have some units from our August 17th purchase, and we still have some units from our August 28th purchase. So that there is more the physical flow of inventory, because you could specifically identify those. But when it comes to FIFO, we're just going to record the cost of what we received first is going to be what we sell first.